Good morning, everybody, and thank you very much for joining us. It's Thursday, the 11th of June 2020, and it's an earlier start for us at 8:30, so I hope everyone's bright-eyed and bushy-tailed. Normally, when we do our finance update with BDO, it's actually at the BDO offices with a delicious breakfast. So whilst we didn't have to have the travel time this morning, it seems a shame to miss the actual breakfast. But I'm delighted to be joined by the experts this morning who all have their areas of specialism, and they will talk you through the areas. And if you've got the agenda, it's a rough agenda, there's no timings on it, but we've got a plan of who speaks after who. We're going to start with Robert. Just one moment though before you start, Robert, with questions, there's a tab on your GoToWebinar panel where you can put questions in. The plan is probably to address all of the questions towards the end after all the presentations have done, but please do keep the questions coming in. And if you would rather ask your question after the event directly to one of the experts, I'm sure they'll be able to answer those for you, or to answer to the best of their ability after the event. So do keep them coming in and feel free to email me with anything specific. I'm now going to hand over to Robert to set the scene for us.
Thank you very much, Jane, and good morning, everybody. It's a bit odd to be addressing you as a plenary session and staring at a computer screen camera, but that's, I guess, the new normal these days. But it does demonstrate very clearly the impact that technology has had on people staying connected, which is so important. I'm Robert Barnard. I'm the partner responsible for hospitality consultancy at BDO, and I'm just going to address a few remarks, which is really a synthesis of what I've been gleaning from the commentators and the various webinars that I've attended over the course of the last few weeks. And just as Jane said, to set the scene for the sector before we get into the nitty-gritty technical information. And it's clear that hotels and the wider hospitality sector have been among the worst hit industries during the COVID-19 lockdown. There will be new challenges when hotels and restaurants are able to reopen, but also potential opportunities for operators and investors able to adapt quickly to the post-lockdown world. The government unveiled its three-step plan out of COVID-19, which has allowed businesses in some sectors to reopen. However, hotels remain in full lockdown, except where they provide accommodation for specific reasons set out in law, such as for key workers or the homeless. Hospitality businesses will have to wait until step 3 of the government plan, which is expected no earlier than 4th of July and is subject to 5 tests being met and future scientific advice. However, there now appears to be talk of lifting the restrictions. 22nd of June had been mentioned, and also of reducing the social distancing limit of 2 meters. Unfortunately, this has now been quashed by the business secretary, Alok Sharma, at his press briefing on Tuesday. When hotels do reopen in July, the sector will have endured one of the longest and most damaging lockdowns to hit any part of the UK economy. The hotel industry is currently in survival mode, with businesses forced to conserve cash and liquidity until operations can resume. Some forecasts suggest 40% occupancy when hotels reopen, 50% in 2021, and 2019 levels returning in 22-23, but ADR a year later. The biggest casualty will be GOP, which is unlikely to return to 2019 levels until 2024-25. The measures taken by the government have been crucial in helping hospitality business stay afloat during lockdown, including 12-month business rates holiday, grant funding and loans, and the coronavirus job retention scheme. However, these have not been enough to prop up all hotel businesses, and several smaller and independent operations have gone into administration since the beginning of lockdown, with COVID-19 cited as a contributory factor. Many hotel operators will be keenly hoping that they're able to reopen in July so that they can have some semblance of a summer season. It is possible that there will be a boom in UK staycations once the country is fully out of lockdown, as people make up for the cancellation of holidays planned earlier in the year, while international travel also remains restricted. Hotels in attractive holiday locations such as the Lake District and coastal resorts may thus be best placed to recover in the short to medium term. Guests are expected to favour well-known hotel brands, which are more likely to be trusted to implement improved hygiene and cleanliness standards than less familiar independent hotels, B&Bs or Airbnbs. Indeed, we have seen major brands partnering with hygiene companies, such as Intercontinental partnering with Diversey. A slower recovery can be expected in hotel markets that have been historically reliant on demand from overseas tourists or business travellers, and indeed those dependent on meetings and business events. Tourism industry experts warn that it may be some years before international travel volumes return to normal, while business is likely to be down, perhaps permanently, if COVID-19 ushers in an era of increased virtual meetings and less face-to-face business contact. Even when hotels do reopen, it will not be business as usual, and the generally accepted service standards will change substantially. Social distancing at whatever distance and enhanced cleaning measures will need to be introduced, and thought must be given to every touch point where guests interact with hotels. Social distancing, public areas such as hotel lobbies and restaurants will need to be reconfigured so that there is appropriate spacing between guests. Social distance markers may be needed across hotels, with protective shields installed in such areas as reception desks. Face-to-face interaction between staff and guests should be minimized, with contactless check-in technology used if possible. Cleaning and hygiene. Hotels will be expected to implement enhanced cleaning procedures, with all surfaces frequently disinfected and high-touch areas such as door handles and light switches regularly wiped. Menus and information guides will need to be protected with plastic covers so that they can be wiped, and cleaning staff may need to wear personal protective equipment, PPE. In-room amenities, hotels will need to rethink room amenities so that the risk of viruses spreading between guests is minimized. Items that could be used by a guest and left behind in a room may need to be removed. Single-use toiletries, which many hotels have been phasing out for climate change reasons, may be seen as more hygienic than multi-use bottles. Food services, hotel restaurants may need to operate at reduced capacities with staggered meal times to maintain social distancing. Buffet and self-service facilities will need to be reconsidered on hygiene grounds, while customers may also be made nervous by intrusive table service. Hotels could increase the serving of pre-prepared packaged food or offer enhanced options for in-room dining. Hotel facilities, amenities such as gyms, pools and spas could present particular risks for virus transmission, and special attention may need to be given to social distancing and hygiene standards. And the impact of that is particularly at the upper end of the market, where the spa function is such an important feature. Much of this will require a complete change in hoteliers' mindsets. Social distancing measures are directly contradictory to the attentive personal service and regular contact with guests that many would have previously seen as best practice. Historically, the hotel industry has bounced back relatively quickly after economic downturns, but the current recession is unique. COVID-19 has created challenges that could linger for months or years. In the immediate term, the need for social distancing will present operational issues, while reduced international and business travel could have a structural impact on demand. However, hotels that are able to adapt quickly to changing expectations and to find innovative solutions to the challenges posed by the lockdown world will be in the strongest position to survive and flourish. There will also be opportunities along the way for investors able to anticipate where value may emerge in the sector. Thank you very much, and I'd like to hand over to Mark Edwards.
Thank you, Robert. Jane, would it be possible for me just to share my screen? If we can get the tech to work. I had a disaster this morning losing my technology, so hopefully this will work. Thank you so much. Okay, good morning, everybody. It is a pleasure to be talking to you all this morning, but I have to say I'm very much looking forward to doing this in person as soon as possible. Normally, as you know, when we present this update, we take a little bit longer and we go through in some detail. But for one reason or another, these webinars tend to work by being a bit shorter and sharper. And of course, the number of issues that people are trying to deal with is quite varied. So I'm going to headline various matters, and then we've allowed plenty of time at the end for questions to come through, which we'll happily answer. So please do send questions through and we will look to answer those as best we can. So I'll just through. I want to cover today, so a little bit on IFRS developments and then UK GAAP. We've got some energy and carbon reporting, the Section 172 in the Companies Act, and then of course no presentation would be complete without a COVID-19 section. And as an auditor at heart, I will cover the impact on audit. Unsurprisingly, I'm very sympathetic to auditors at the moment. So IFRS 16, as you know, I tend to talk about IFRS 16 a lot on calls like this. And certainly recent events have led to increased activity with regard to IFRS 16, clearly only relevant for international financial reporting standard preparers. But there have been a few developments or clarifications as the standard has come in. So in particular, the first point here on enforceable periods. So this is acknowledging that certain leases will have a legal term, but actually there are shoulder periods around that legal term when actually it's expected on both sides that continued occupation may take place, most commonly where there's ongoing negotiation about a new term. So that looks at enforceable periods. The next point in IFRS 16 is about COVID-19 related rent concessions. So that is where there is a rent holiday or a rent amendment, either to timings of amount to pay or the actual amount to pay, and potentially renegotiations on length of contracts. And of course, in some cases, changing the nature of the rental structure from a fixed basis to a more variable one. So there is a whole raft of documentation and following an exposure draft going through all of that. I won't cover the details on that now, but if you are in that situation, well worth getting to grips with that standard. There is a peculiarity that any IFRS standard needs to be endorsed in the EU before it can be adopted. So where we currently stand, it sits as an expectation that it will be endorsed potentially by the end of July, but it can't officially be adopted until that endorsement has taken place. So it's a bit of a watch this space, but it's clearly a very important element of the standard coming through, and it will apply to any rent concessions being given right through till June 2021. The next point relevant particularly to hotels is on incremental borrowing rates, and a number of people have had this challenge where you have an external borrowing rate, a bank debt rate, which you might like to use quite sensibly as your borrowing rate. But of course, that tends to be much shorter term than the length of many leases. So there is a piece around trying to understand how much weight should be given to actual external borrowing. So again, a bit of clarification there, which is helpful for preparers. So in each of those cases, if you think that that is relevant to you, well worth reaching out to your advisor or give us a call and we will happily go through that in detail. The next point on IFRS 15, the revenue standard. is about considerations of refunds for cancellations. And in a sense, this might seem obvious, but it came up as an initial query in the airline industry about providing refunds, and the interaction of IFRS 15, the revenue standard, with the provision standard. So that is to say, if a refund is going to be given, is that a reduction in revenue, or is it actually a provision for a later event? And there's been a clarification which in essence says if you are giving refunds additional on top of the amount originally paid or the refund initially, then that should go against revenue and not against a separate expense code. That then becomes more challenging if you are holding on to deposits for events, say, and promising something on top of the original deal, which is happening in a number of negotiations. Again, that is going to need some detailed investigation case by case. So flagging it here, if you are an IFRS preparer and that's the kind of thing you're looking at, do watch out for that standard and consider the impact on revenue and what that obviously may then have through your HMA. Final bit here, IAS 1, and then uncertain tax liabilities, which IFRIC 12. And this is basically saying there are a number of tax rates which are moving around the world. There are a number of uncertainties around planning measures and around what the rate of tax people might think they will pay by the time they get to their year end. And the issue here is around where are those uncertain tax liabilities presented, which balances and how they're calculated. So this basically goes through and says any tax liability, whether certain or uncertain, should sit within tax lines within your P&L and balance sheet. So a clarification there, which is helpful, and then IFRIC 12 looking at the uncertainty. So again, if you are in a position with uncertainty, do seek advice if you need it. Final point, offsetting, which is actually relevant to UK GAAP and IFRS. It's the same point. This is really a heightened focus on the fact that lots of preparers offset balances, most commonly between deposit accounts and overdrafts. And there's a clarification which is basically pointing out the fact that in order to offset, you need not only the legal right to offset, but the intention to actually offset in terms of settlement. And in a lot of cases, while people may have the legal right, so either overdraft deposit accounts or across group facilities, you may not have the intention to actually net settle because balances are moving around all the time, etc. So it does mean a little bit more thought perhaps as you approach year end as to how those cash balances actually sit and work through. So just highlighting that one. It isn't really a change, but perhaps it's come under the spotlight a bit more with recent events. Moving on to UK GAAP. So you will remember from previous years, we have been signposting the triennial review 2017, which now comes into place from the 1st of January 2019. Not a massive change in reality, just a few bits here. Issues like loans from director shareholders, intangible assets acquired in business combinations, so a slight rephrasing of what an intangible might be, more likely to have goodwill balances, and then investment property rented to another group company, a change there in terms of not requiring fair value. There are some disclosure changes as well, so some new disclosures, the net debt reconciliation, which for those with long memories will recognise is an old UK GAAP disclosure which was removed and has now been put back. The carrying amount of investment property rented to group undertakings is a new disclosure. The well, as it says there, qualitative description of the nature of intangibles included in goodwill. So that is, if you are no longer separately identifying intangible assets, they would now be included in goodwill, then there should be greater description of that. And then a clarification of what might sit in operating profit. On the flip side, there are some removed or simplified disclosures, and the stock one is, in a sense, the most interesting, still required in IFRS currently, but no longer required in IFRS 1 and 2. And then some other exemptions and clarifications. A bit more detail on that. these are quite specific, so you may or may not come across them, but financial instruments, I guess the key one here is where you have a floating position on your loan balance that you have swapped to a fixed one, and where you are accounting for that as a hedging instrument, then you may continue with the IAS 39 treatment, even though IAS 39 will no longer exist. So this is this wonderful new world we enter, where we are now applying standards which are no longer in existence, which is one to look out for. So yes, relevant for certain preparers, but not all. There are some elements which are removing exemptions which previously existed, so particularly watch out there for investments in associates and JVs. And then there are some very specific bits around PPE, and again I suggest you consult with an advisor if you have any of those kind of scenarios. So the next area is we move into narrative reporting. And climate change, if we can remember back to a period not that long ago, this was all the rage, and various cities being brought to a standstill by protests. And of course, government does what government does, which is react by deciding we need a lot more written in the accounts because they're not getting long enough already. So additional disclosures on climate change and related environmental disclosures. So this is coming in earnest. So keep an eye out for this. There was some talk about delays, which we're yet to see, but really from the 1st of April 19, you've got some obligations to consider. Is particularly relevant for large companies. So this just sets out who is having to do what, but you'll see the section 172 large companies directors' response to the impact on the environment is a key element, and will be most relevant to people on this call. What is new? Well, it's this element around having to comply with various disclosures. It is impacting large companies, and we'll see on this slide over 40,000 kilowatt hours usage. So quite important to get a hand on this. Almost certainly you will need experts to help prepare disclosures and usage for this, because it is not that straightforward. Through various rules, and we'll send through the slides so you can see the details as to what is included and what isn't. Most importantly, subsidiaries won't be needing to do so if parents have disclosed. So what needs to go in? UK energy use with associated greenhouse gas emissions with an intensity ratio, and then information about energy efficiency action and the methodologies. So quite a lot of potential disclosure to go there. And it's really picking up these key issues: electricity, gas, fuel use. Transport, one of the most interesting areas, so we've just used some examples here, but important that there are some exceptions, so it does become complex. An example of that, an individual flying from one place to another for business purpose, so an employee travelling for a business purpose overseas but on a commercial flight, that would not be included within this disclosure. Those emissions would be covered by someone else, the airline in that case. So there are some very specifics where you need to carve out potential emissions. So worth getting those right and thinking it through carefully. For more information, the government has produced various bits of guidance, so do keep a lookout for that, and otherwise we are always happy to help. The next point on narrative reporting is on section 172. Please forgive me when I start going into jargon here, but 172 is a part of the Companies Act which covers the strategic report. It's an additional element of the strategic report, and it really comes out of some of the corporate failures which were in large private companies, in particular the BHS issue. And the idea is to ensure greater levels of disclosure and transparency for readers of the accounts around how decisions are made for the group or the company. They're relevant to large companies again. There is quite a lot of thinking about how this might work. We have got a number of people already doing this out there, and so we've got the requirements are all about setting out the issues, factors, and the stakeholders that the directors consider relevant, the main methods to engage with stakeholders, and information on the effect of that for decisions and strategies. Two main approaches have been taken for this. One is the stakeholder analysis approach and the other decision or activity based. So the stakeholder approach goes through the various stakeholders in a business and looks at how engagement has happened and what that has resulted in. The risk that we see in that is that not all issues that you might consider, including environmental, impact just one stakeholder. In fact, impact a lot of different stakeholders. And so you're not necessarily describing the actual decisions in terms of those interactions and how you got to the final decision that was made. So you get overgeneralization, a bit generic disclosure. We would recommend a decision or activity focused approach, looking at the key decisions in the year, the stakeholders impacted, how they were engaged, and what happened as a result of that. So there's a real focus on the decisions and the activities of the company, and ideally a greater clarity. Clearly, this is an area which is going to develop over time, and so we will see what happens. But in particular, this is focused on developments in the year, but for a number of preparers, they may wish to also factor in some of the post-year-end decisions they've had to make, particularly regarding COVID. These are a list, but not exhaustive list, of examples that may be disclosed, including acquisitions, disposals, restructuring, expansions, but also, of course, downturns in the sector. So various things to consider in terms of preparing that Section 172 statement. So just the summary of our views. It's relevant for all large companies. We recommend a decision-based approach. It's for decisions taken during the period, but you'll need to balance that with post-year-end decisions if indeed COVID-19 is post-year end. It is a separate section of the strategic report, and cross-referencing, if you were to hold it somewhere else, that should be kept to a minimum. So it gets signed off as part of the strategic report. So everybody's favourite topic, coronavirus. Let's have a quick look at some of the issues. What tends to happen, of course, in a downturn when everyone is focused on operations is that the regulators and the accounting firms get busy drafting pages and pages of largely incomprehensible advice. So we have tried to make ours as straightforward as possible, but I will forgive anyone for having to sort through the key points from the detail. It is moving incredibly fast. So any guidance at the moment sits with huge levels of caveats because of how quickly the situation is developing. So just a few things to highlight. This picks up December 2019 year ends, and for the most part, a 2019 year end is going to have COVID-19 as a non-adjusting post-balance sheet event. So although the first cases in Wuhan were announced just before December 2019, it was the 30th of January when the WHO decided this was a health emergency, but not until the 11th of March when it was declared a pandemic. So there is a timeline to think through in terms of which year end might get caught by an in-year event. If it is a non-adjusting post-balance sheet event, then the key areas to think about, of course, are forward-looking, and so they pick up all of these points being raised here. With regard to significant estimates and judgments, you are supposed to take a view as at the balance sheet date with information known at the balance sheet date. So a non-adjusting post-balance sheet event is exactly that. It should not adjust any view at that time. But clearly, while it's easy to say we should avoid hindsight, that is not as straightforward when you're actually coming to make these decisions and pull accounts together. As soon as you do an in-year event, you suddenly have a whole array of things to think through, which of course are not straightforward. So these go on top of your operational challenges. We're now thinking about how do we account for covenant breaches, for covenant waivers, for renegotiations, any onerous contracts, how does your insurance work and the accounting for that, deferred tax or any tax liabilities for that matter, lease terms, and of course section 172, which I've talked about already. So an array of matters to consider. I think it is fair to say that this year end, whichever you're working through at the moment, will be one of the most complicated and potentially painful to actually finalise in terms of accounts disclosures. I will mention going concern here, and this is a real shout out for the auditors. We have been warned by our regulator that no matter how clear we try to make our responsibilities on going concern, there is a high likelihood that we will be assessed with hindsight, which is never pleasant. So there's an approach which has been worked through by our regulators and the largest accounting firms to ensure that there is guidance for directors in terms of how to prepare going concern assessments. And really it looks at three particular lenses: the operational capacity of a business, the market demand, and structural finance. And in essence, the starting point is to say, let's do a reverse stress test. So that is to say, at what point does the business fail to be able to continue to exist, and what actions are available to the directors to avoid that happening. It becomes relatively depressing quite quickly, so well worth engaging in early. The flip side of that, of course, is that things can change quite quickly. So it's one to talk through with auditors, but also very much bearing in mind any director has a real corporate responsibility here to ensure not only the decision is right, but of course the disclosure is right as well. So a real challenge in the current environment. I just want to pick up a couple of frequently asked questions, which we are fielding quite often. I'm very happy to answer other questions at the end of everyone's presentations, but these are the most common that we have. So firstly, cost of recommencement. So probably most particular, this might be to a, say, junior end, thinking ahead about costs that are going to have to be incurred in order to reopen hotels. Can they be provided in the junior end, effectively get the bad news out of the way? And the answer to that generally is no, costs should be incurred as they're actually used, so you can't provide for costs not yet incurred. So you just want to really watch out for, clearly, purchases of equipment, etc., no problem, but if you know that you are going to have to pay extra in the future, that needs to be expensed as incurred. The next common question is depreciation holidays. So if you've had to shut your business, the assets are no longer working for you, logically, therefore, surely there should be a holiday from depreciation charges. But the answer to that, unfortunately, is no. The depreciation calculation would continue as previous, with very few get-outs under either GAAP there, neither IFRS nor UK GAAP. So no depreciation holidays allowed. There could be some very, very specific examples where that isn't necessarily the case, but I think it's fair to say you should assume highly unlikely. The next point I've covered to some degree, adjusting and non-adjusting post-balance sheet events. So at what point does your business get impacted by this? I think we would say December 19 as a general rule is pretty clear. It would be non-adjusting post-balance sheet event unless you had significant operations in Wuhan. By the end of March, you're pretty clear that it's an in-year event, but in between it will depend where your business is, where your customers come from, how much you were impacted or you felt business being impacted before then. So there is judgment to be made there and considered, and obviously that can have quite dramatic impact on your disclosures and your accounting. The next point, furlough scheme accounting. There's two elements about this actually in a way. One is the furlough scheme clearly has an obligation on those applying for it that they will calculate the amounts due correctly and fairly, and we know that HMRC are ramping up their reviews of this, so that is one to be aware of. In terms of accounting, the key issue is, do you account for the cost net or gross? And in most cases we see the furlough scheme as being a government grant, and government grants are accounted for in a particular way, but a different way under UK GAAP and IFRS potentially. So under IFRS, government grants can be accounted for net in the P&L, but gross on balance sheet. So in other words, you can offset the credit you are receiving for furlough against payroll costs. Under UK GAAP, both FRS 101 and FRS 102, you must present those gross. So you'll have an other income line, most likely representing the credit, the government grant for the furlough, and you will keep your gross payroll costs. In either event, the Companies Act required disclosures around employee costs will always be gross, and in both GAPs, the balance sheet will be accounted for gross. The next point on leases and rent concessions. So the IASB, that is the international accounting body, standards board, says for IFRS 16 leasing standard that rent concessions should be factored in and adjusted. But in the UK, for UK GAAP, FRS 102 in particular, that does not yet exist. So the assumption is that any rents will continue to be charged as they were originally. So that may change, and we hear rumours that that is being considered, but as yet nothing confirmed. So there is a gap difference there to consider if you have leases. Finally, post-year-end bonus waivers. So where you have a year-end where you were assuming you would pay bonuses, but then because of recent events, you may not pay that bonus. There's a question as to how you should unwind that. As a general rule, this adjusting and non-adjusting balance sheet issue crops up. So if you had a December year end where you are treating COVID-19 as a non-adjusting post-balance sheet event, you accrued a bonus, but then you aren't paying it because the world has moved on, then that reversal of the accrual would happen in your 2020 year. Clearly, if you were at March, you may not accrue it in the first place. So anywhere in between could have either judgmental. So one to really watch out for, but it is key to get that adjusting, non-adjusting post-balance sheet event decision right, and then it will impact other areas. Okay, whistle-stop tour, and apologies for that, but if you do have questions, please do reach out. Otherwise, I'm happy to field any questions after the webinar and so on. Just a couple of final bit, and just to introduce our RETHINK framework. So we are beginning to pick this up with our clients in terms of thinking through the next stages for coronavirus in particular. And really we're looking at our model in terms of a react period when you first need to react to what's going on. I think a few weeks ago, that was considered, maybe months ago now, considered a pretty stressful time and hard work and unlike anything we've ever known. But it turns out that reopening may be even worse and harder. So there's a resilience stage in terms of how do you actually try and get back to a sustained level of operation. And then the realize stage, as you move through that, rebuild the business, rebuild confidence from customers. The realize stage is around what changes that are coming through are going to be permanent and structural in our market, and how are we going to react to those? So do we need a change in our cost base? Does it need to be more flexible? And how do we do pricing and so on? And really, where are our markets? So we're working through talking with clients through this model. This is just an example of how we anticipate businesses are working through their core risks in the different stages. Clearly, some of the key areas here are going to be around people and the workforce. And then within risks, we've got supply chain down here, but because we've covered regulation on the far right and people on the left, so they might well be the key areas of focus. And of course, you need to get your operations right and your financials right. So there's going to be a huge level of uncertainty for some considerable time. And I think, as Robert has set out, while we hope that there will be a recovery which confounds all expectations and is quicker than we might imagine, I think the reality at the moment for planning purposes is that this might be a bit of a long haul. And so we need to make sure businesses are prepared and ready for this new normal. So I will leave that with you as part of our read. Wish to talk that through in more detail, we would be delighted to talk to you. Thank you very much for your attention, and I shall pass over now to John, who will pick up.
Thanks, Mark. Good morning, everybody. I think half an hour of accounting standards is enough for any audience. So we're going to move on to some tax, which I'll start off with. The theme throughout the next 3 sessions is around cash flow management for you and how tax can help. I'm going to cover off time to pay and the use of corporation tax losses before I hand over to Martine to talk about VAT and Kay to talk about R&D. So moving on to the next slide. Time to pay. Thanks, Mark. So I think we'll all be very aware of, from the outset of lockdown, HMRC was actually very supportive and agreeing time to pay, and I think actually credit to it for doing so. It has lots of, often for good reasons, it comes under criticism, but I think on this occasion, personally, I think it actually did a good job. And to achieve that time to pay was very straightforward, wasn't it? It was simply phone the helpline. It got more and more difficult to get through, but once you got through, you didn't need to discuss or provide any financial information. You just asked for, in particular, your PAYE and NIC. Martine's going to touch on corporate and also corporation tax. Martine's going to touch on VAT next. And you were able to obtain a deferral. That deferral, ignoring VAT, was through to the 30th of June, which of course that date is now fast approaching. And I think given the impact, the ongoing impact on our sector, it's time to revisit the situation. So HMRC's view going forwards, as of the 30th of June, first and foremost, furlough payments, PAYE and NIC, must be paid over to HMRC and into the Exchequer. This is really quite an emotive subject. Mark's touched on it already. There's already significant press commentary about furlough abuse, and it is a very emotive subject. I was reading the draft legislation that's working its way through the finance bill at the moment, and there are some very, very punitive penalties for furlough abuse. So just to summarise, in respect to furlough payments, PAYE and NIC must be paid. There will be no time to pay arrangements agreed. So what does the future of time to pay hold for us? Well, it's going to be reverting back to pre-lockdown approach of HMRC. So that is very much on a bespoke basis, particular facts and circumstances. And definitely the advice is, particularly with 30th of June coming up as quickly as it is, don't wait, be proactive. A traditional time to pay arrangement, apart from on really quite small sums of money, actually takes a bit of time to get through and to get agreed. Usually there's at least 2 levels of governance. It has to be signed off within HMRC. And I think we must assume that HMRC's debt management teams will be in contact very shortly after the 30th of June in relation to any of the deferred payments that we've already agreed. And it's for us to put our proposal to HMRC. So we need to be proactive. We need to come forward and say, here are the liabilities, and this is what we would effectively like to do in terms of repaying those liabilities. And we will be expected to produce supporting financial information. For a business, typically that would be cash flow forecasts over the life of the proposed payment plan. We are going to be expected to look to external sources for financing, and indeed leveraging assets, including even shareholders injecting funds into the business before HMRC will agree the payment plan. A typical repayment profile is they want an amount up front in relation to the proposed liabilities that are going to be subject to the payment plan, regular payments, and certainly no balloon at the end. I've got an ongoing situation with a client at the moment that he needs a balloon because but it is contingent on selling an asset, in this case a property, ironically a hotel, and because of the current environment, there's no certainty that will happen for obvious reasons. And at the moment, HMRC is just refusing to accept the payment plan. So the position in relation to balloons is they just do not like them for probably good reasons. The payment plan and the cash flow forecast needs to factor into account ongoing tax liabilities of all sorts. So that's broadly what they're going to be expecting, and they will be subject to, as I say, 2 levels of governance at least. Question of how do we do this? How do we engage with HMRC? Well, if you're large enough that you've got a customer compliance manager, then that's the person to go to. If not, then it's the usual phone lines, I'm afraid. And within HMRC, the debts will be split into those over broadly 750,000 go into the large debt teams, and in effect come under more scrutiny. But yes, it's the usual phone lines that you've probably previously called. What will also be influential in HMRC's thinking is, have we got a good track record in paying pre-COVID-19, or have we previously needed time to pay? And have we, if we have then needed time to pay, have we actually honoured the agreement? So that's time to pay. Moving on to the next slide, please, Mark. Corporation tax loss claims. This is effectively using the corporation tax self-assessment process to try and free up some cash flow from HMRC. And essentially, if you're forecasting trading losses in the current trading period, which I suspect unfortunately many are, then it is possible to make an early claim for losses to be carried back to last year's profitable year, assuming we were profitable and we were paying corporation tax. And the corporation tax that we've paid will be capable of being repaid back to us up to the extent of the losses that we are forecasting. The fact that we would be making it before our year end and before we filed a corporation tax return for the current period means that it will come under some scrutiny by HMRC. And therefore the financial information that's underpinning what our current forecasting is needs to be very robust, and there needs to be sensible assumptions and forecasts. The process for doing so is actually just using the self-assessment system, which is we've got 12 months to amend our previous year return, which we can do. We can make the loss claim within that. And HMRC is protected because it has 12 months then to inquire into that previous return in relation to the loss claim, by when, of course, the actual realised loss for this year will become apparent by reference to the accounts and the tax return to be filed. So it's early days in relation to this for obvious reasons, but the indications from HMRC are that they will be willing to consider this. But of course, we do need to make sure that the financial information from which it's based is robust and sound. So that's me finished. I'll hand you over to Martine now to talk about VAT.
Thanks, John. So what am I going to cover in the next 5-10 minutes? Have the next slide, please, Mark. So I'm going to cover COVID-19 and in particular the VAT deferral. I'm going to talk about some of the cash flow ideas and opportunities that you might want to have a look at as we move out of the deferment period and into the normal VAT life. I'm going to then talk about some of the practical considerations that you might want to consider, a few bits on property, and then just a little good update on making tax digital. Now the date's been moved out, and a reminder that we've got Brexit coming as well. So lots and lots to think about as normal on the VAT side. So, as John said, we are now coming up to the end of the deferment period for VAT purposes. So what have we been able to achieve since the 20th of March? So on the VAT side, we've been able to effectively defer all VAT payments. So payments for VAT returns, payments on account due between the period of 20th of March and 30th of June. So I think by now, most of the deferments that could be possible have probably been taken advantage of. So as we move forward to the next VAT return and the next VAT payments being due after the 30th of June, we now start to think about how we're going to finance any of those payments, albeit with this industry, we may be seeing a different pattern with regard to VAT payments. So the original VAT deferment didn't apply to any customs duty or any import VAT, albeit for this sector, we do tend to see little amounts being incurred by way of those type of costs. John mentioned on his previous section a minute ago that a lot of businesses will be required to make payment and may have to look at time to pay arrangements. With regard to the VAT position and those VAT deferments falling between 20th of March and 30th of June, HMRC have actually confirmed that the deferred tax doesn't need to be repaid until the 30th of March 2021, which actually at the moment seems like a long way away. But if you think about trading patterns and income that may fall due between now and the 30th of March, businesses may still struggle, especially in the hospitality sector, to meet those VAT liabilities come 30th of March 2021. Next slide, please, Mark. So unlike normal time to pay arrangements, the VAT deferment was really straightforward. So there was no pre-agreement necessary with HMRC. Originally, we were advising clients to call HMRC to say that they wanted to defer their VAT payments, but actually, as the days went past, there was less requirement to do so. One thing to watch out for with regard to that is that whilst the VAT payments were not need to be settled or due between those periods, what often happens with HMRC is that if you don't make a payment on time, or if you don't file a VAT return on time, the system actually generates automatic default surcharge notices. So one thing to watch out for is that if you did defer your VAT between that period of time, it may still be the case that the HMRC system may send you an automated default surcharge notice. And the really important thing there is that if you do receive one of those, and for those on the line that don't know what they are, so effectively, to start with, if you don't make your payment or if you don't file your VAT return on time, you'll get a letter from HMRC. The letter will basically say that you fall within a 12-month default surcharge period notice, which means that you must file your VAT returns and make payments on time in the next 12 months, otherwise you'll receive a penalty. So the penalties can rack up quite quickly, and they're basically set from 2 to 10%, and that will apply for each VAT return or each payment that's not made by the required date. So the really, really important thing is that if you have received a default surcharge notice due to COVID, that you must call HMRC and you must tell them that you've received this through the post and ask them to remove the default. And the key reason for that really is that if you were to default again outside the COVID period, but within that 12 months, you may get levied a penalty of 2%, 5%, 10%. So it's very important that they remove those defaults from the system, because they're not automatically doing that at HMRC Head Q. So just watch out for that. Another interesting point is that we were telling people within the period to make sure that they cancelled their direct debits. So some clients pay VAT due to HMRC on a monthly basis if they fall in the payments on account regime, and they often have a direct debit set up to make that payment to take the money. So we have been advising clients to make sure that they cancel their direct debits due to HMRC for payments due between 20th of March and 30th of June, but then to remember to reset those direct debits after the date, so after the 30th of June, to ensure that they don't default by accident. We had a very interesting client question come up last week around the direct debit actually, and it was in respect to the fact that the client had failed to cancel the direct debit, and obviously the direct debit was taken and paid to HMRC. And the question to us was, well, surely the VAT shouldn't have been taken by HMRC, and surely the VAT can be repaid from HMRC because it falls within the deferment agreed with HMRC on COVID for VAT. HMRC have set out some guidance, and there has been some commentary over the last week or so regarding how clients can go about obtaining those direct debit payments back. So if a payment has been taken by mistake due to COVID, there is that chance, that opportunity to try and get that back from HMRC for that COVID period. So I mentioned earlier, import VAT cannot be deferred. So I don't think that will be too relevant, as I said earlier, for the hospitality sector. So we can move forward on that. Next slide, please. Right, so what can businesses do? So VAT is quite an interesting area of tax because it can affect the bottom line. If you can maximise your VAT recovery on your purchases and mitigate any VAT paid or due with regard to transactions and sales made, then it can increase your cash flow. So we've also been looking at cash flow opportunities. So what can you do as a business to enhance your cash flow through VAT? There are some simple things on this slide that you can have a look at. So things like if you're normally a quarterly VAT return filer, and you were in a position where you were making quarterly payments to HMRC, obviously hotels haven't been open, hospitality venues haven't been able to trade. So it may be the case that you may now switch from being a payment trader to HMRC to be a repayment trader. So claiming back money from HMRC on your VAT returns each time you file. If your business has kind of moved to that kind of pattern, one thing that you can have a look at is whether you want to change your VAT return stagger. So your VAT return stagger is effectively, do you submit quarterly VAT returns? It may be possible to go on to monthly VAT returns. And whilst this means slightly more admin with regard to having to file more regularly, if you are regularly going to be reclaiming VAT from HMRC for a period of time, then getting that money back from HMRC quicker by filing monthly returns is almost a no-brainer. Relatively easy to switch, albeit at the moment it's taking about 30 days for HMRC to process that through their systems. A couple of other areas, payments on account. So if you're a large VAT payer, so you normally pay in excess of 2.3 million pounds of VAT per year, you'd fall into the payment on accounts regime. So basically under payments on account, you would make a payment to HMRC each month and then a balancing payment when you file your VAT return. And typically HMRC will issue a payments on account schedule each year, and it will be based upon the liabilities paid in the prior year. Now, obviously life has changed quite a lot this year, and therefore the trading and the turnover in respect of your operations this year will be very different to last year. So one thing we've been saying to clients is that if you're falling in the payments on account regime, it may be a good idea to take a look at the amounts of VAT that you are going to pay and to have a conversation with HMRC, either to remove yourself from the regime if you meet the limit, to get yourself excused from that. What would happen there is that you'd move on to normal quarterly or monthly accounting and pay your VAT as normal, rather than to have to pay the monthly payments on account that will be due. Or if you still fall in the payments on account regime, is to have a look at agreeing an actual payments on account based upon your actual trade. I think it's highly unlikely at the moment that those on payments on account will probably have the turnover and have the VAT payments in to actually fall within their prior year payments on account schedule. So definitely something to take a look at. Bad debt relief, that's kind of very topical at the moment. So typically you can claim bad debt relief on your VAT return if you have any debts that haven't been paid within 6 months. Now I know hospitality and the hotel sector is a little bit different because it's more real-time payment. So you often don't get a hotel room booking in the books unless you've received part or whole payment. But if there are any ancillary payments that you receive from suppliers such as chargeback payments that haven't been paid to you within 6 months, then you can adjust the VAT on your VAT return for those. But be careful as well, because the bad debt relief rules also relate to your business where you've not paid the VAT to your suppliers within the 6 months. So there's an automatic requirement to adjust the input VAT that you may have claimed on your VAT return if you meet those criteria. So just something to watch out for there. As with anything, like I said at the start, the way to increase cash flow, one of the ways is to look at, are you recovering all the VAT on the purchases that you're able to, and are you recovering that VAT as quickly as possible? So moving on to monthly VAT returns, but also have you seen a slowdown in respect of the AP processing of your purchase invoices? Because obviously if you don't get the VAT on the VAT return within the required period, then some of those chunky costs that you may still be incurring may move to the next VAT return period. So watch out for VAT on VAT recovery on purchases. Next slide, please, Mark. So a couple more areas. So cash accounting and annual accounting, typically for smaller businesses with a turnover of 1.35 million or less. So if your turnover has dipped, it may be possible to have a look at cash accounting or annual accounting. So cash accounting it does what it says. You account for VAT on the receipt of cash versus invoicing. And annual accounting is where you'd switch typically from a quarterly or monthly VAT return position to an annual VAT return position. With regard to the hospitality sector, again, like I said previously, these type of regimes might not be overly applicable due to the fact that turnover will be significantly decreased, and therefore you may just want to stick with normal invoice accounting but move yourself onto monthly VAT returns so that you can claim your VAT back much quicker. The key thing for cash accounting and annual accounting is if you're having a look at those, the turnover value relates to the VAT registered entities turnover, not corporate group turnover. And when I talk about VAT registered entities turnover, I also talk about the VAT group if you have a VAT group in place. Just some other areas. So these are kind of general housekeeping points. So things to definitely check to make sure you're reclaiming VAT on. So employee expenses and petty cash. Agreed, at the moment we may not be having many employees or many petty cash expenses, but the thing to remember is that if you haven't claimed VAT on these areas, you can go back and make a 4-year claim. So if in the past you've thought that these type of costs and the VAT on them are pretty small, actually if you look back on a 4-year period, those amounts might add up, and it's all cash coming into your business, which is all good. Mileage as well, so having a look, do you pay mileage to your area managers or any staff in particular? Again, tiny amounts if you look at them in isolation, but if you've never claimed, you may want to go back 4 years, and as I said a moment ago, those amounts can add up. Alternative evidence. So what I'm referring to here is alternative evidence for VAT reclaim. So normally you can only reclaim VAT if you've got a valid VAT invoice. We've been helping a number of clients consider whether there are any chunky bits of VAT that haven't been reclaimed, where they could look to agree with HMRC alternative evidence for input tax deduction. So one area that we've looked at is in respect of property. So sometimes if you hold a large property portfolio and you are incurring VAT on rents charged by the landlord, for example, sometimes we've seen that landlords will issue demands for payment or pro forma invoices, and these aren't valid normally for VAT recovery purposes. So what we've done with some of our retailers, and actually a couple of the hoteliers in the past, is to obtain agreement from HMRC that alternative evidence can be used to support VAT reclaims. So definitely worth looking at any VAT in the purchase ledger that hasn't been reclaimed if it's chunky in respect of that. Lastly, a couple of areas. So VAT liability. So is there any, do you receive any income within the business that wouldn't typically fall to be standard rated? So anything that could fall to be zero rated, for example, or a true cancellation, for example, can be subject to an outside the scope VAT treatment. So it's worth checking kind of the non-core areas of your business just to make sure that the VAT liability is right, and where it isn't, again, you can go back and look at a 4-year period claim. Partial exemptions on there, but may not be overly applicable to some of our businesses in the hospitality sector. The question here is whether you receive any non-business income or whether you receive any exempt income, for example, with regard to residential property that might be held by the corporate group. We often see partial exemption calculations whereby the attribution, so when you normally look at VAT recovery, you can normally only recover VAT on costs that relate to taxable activities, so like hotel bookings and things like that. But if you receive income that may be exempt, as I said, residential income, you typically can't recover the VAT on those type of costs. An easy win really is to look at the attribution. So when you look at VAT recovery, you would look to see whether there are any costs that can be directly related to taxable or exempt supplies, and anything that kind of sits in the middle that can't be attributed would fall within a calculation to apportion the VAT that might be due. So we do a fair amount of work on attribution just to make sure that companies are recovering the VAT that relates to fully taxable activities. Something to watch out for. Next slide, please, Mark. So just a few practical considerations. So John mentioned earlier that time to pay will become even more important. And I said at the start of my presentation that even though the VAT will need to be paid by the 31st of March in respect of anything that's been deferred, it's going to take a while for businesses to recover. It's going to take a while for income to be at the right level whereby businesses will be able to start to have extra money to repay their debts. So we are going to see an increase in respect of formal time to pay arrangements. John mentioned earlier that that will come with a little bit more scrutiny in respect of HMRC wanting to see forecasts, HMRC wanting to see profit and loss accounts, just to make sure that the time to pay arrangements are set. So I think as we move forward, we need to make sure that we are mitigating where we can any impact of COVID-19, making sure we clear any default surcharges that are not relevant to our business. I think we're probably going to be in a position whereby a lot of the VAT returns going forward for the rest of the year may be repayments. So I don't think we probably have an immediate concern around, do we have the money to pay the next 6 months worth of VAT that will be due in VAT returns coming after the 30th of June. But I think we're still going to be in a position maybe by the 30th of March where we might have to go down that kind of formal time to pay. And it's worth having those thoughts and worth having those conversations before we get to the 31st of March if we think that we're going to be in that situation going forward. Next slide, please, Mark. So just a couple of things on land and property that have come up in the last couple of weeks that are interesting. Mark, you touched upon this in respect of your slides on the audit side. So going concerns. So from a VAT perspective, we have this concept that you can transfer trade and assets, and provided that you meet certain conditions, you can transfer them on a VAT-free basis if they fall within the transfer of a going concern VAT conditions. One of those conditions is that there must not be a break in trade in respect of the normal trading pattern. So you would transfer the business, the new operator or the new purchaser would continue to trade that business as it was previous. So we've had a few questions around, I've purchased a business, I've met the conditions of the transfer of a going concern for VAT purposes, but actually I can't trade because of COVID. What does this mean? And HMRC have said that in their view, provided that you meet the TOGC conditions at the time the business was transferred and the break in trade has come about as a result of COVID, then there should be no clawback or no VAT being crystallised in respect of that transaction. But it's definitely something to take a look at if you have made or if you have sold a business or acquired a business in the last few months. And it also might be worth speaking to HMRC just to get on the record and get something in writing from them that there won't be any change with regard to your VAT treatment that you have applied in the kind of the VAT-free TOGC position. Again, Mark, I think you touched on this as well with regard to leases. We are seeing a number of lease assignments, variations and disposals, rent-free periods, negotiations happening with landlords regarding non-payment. And I suppose the thing that I want to just highlight here is that if you are doing any of those things, they may have VAT implications. So if you're assigning a lease, if you're agreeing a deed variation in respect of an existing lease you have, or you are disposing of properties that you no longer require because you're not going to open certain sites, then you must think about the VAT implications, and you must think about that from a commercial perspective as well with regard to the contracts and what your contracts say with regard to VAT inclusive amounts that may be due. Just an update on option to tax notification. So with land and property, typically if it's not a piece of land and property that's under 3 years and it's a commercial property, if you were to sell a commercial property over 3 years, normally it would be exempt from VAT. This is unless you formally notify HMRC of your option to tax. So you can make exempt commercial property taxable by writing to HMRC and agreeing that's how you want to treat it. HMRC have said that due to their processing and communication and the fact that businesses may take longer to do things, they've actually allowed an extension to the option to tax notification period. So normally you would notify HMRC within 30 days of your decision to want to make a property taxable. They've said that there will be an extension of 90 days for decisions to opt to tax made between the 15th of March and 30th of June. So if you have decided that you're going to do something in respect of disposal of properties or lease assignments and you want to opt to tax, you still, at the moment, you have 90 days from a decision to notify. But please note that post 30th of June, that will revert back to the standard 30 days. Last thing on property is the domestic reverse charge. So there's been a lot of talk and pushback with regard to domestic reverse charge and when that will come into play with regard to the switch in the liability for the acquirer to account for VAT rather than the supplier down the chain. Now that's been delayed again, so we now expect a date of the 1st of March 2021. So lots of things happening in March next year, so it's something to watch out for and something to plan for. A couple of last things. So making tax digital. So over the last 18 to 24 months, we've seen the introduction of making tax digital, and we were supposed to see the introduction of phase 2, which looked at whether your VAT returns could be digitally linked from the export out of your accounting system up to the API upload to the HMRC new portal. HMRC have basically come out and again said that they're looking to defer phase 2, so that digital link criteria will not come into force until the 1st of April 2021. So again, businesses will have a slightly longer period to ensure that they meet that criteria, and there's no guarantee as to whether that might be deferred further, like the domestic reverse charge may be as well. And then one final reminder that whilst COVID has been dominating the world, Brexit still remains on the table. So although not overly relevant for the hospitality sector in some ways, especially if we source from the UK at the moment, Brexit is still coming. We need to think about any supplies that may fall within the kind of the Brexit supply chain and the impact that will have from the 1st of January 2021. We've had no indication from HMRC whatsoever as to whether the kind of the lead-in period will be extended further. And as far as we have been made aware, it's still coming. HMRC have released new tariffs for customs duty, for example, that will come into play. Now, I say not overly relevant for the hospitality sector if we source locally from the UK market, but those international hoteliers may move stock, may move assets within Europe or outside of Europe, or may source centrally. So it may still be something that we need to have a think about as we move forward for the rest of the year. So that kind of concludes where we are. So from a VAT perspective, I suppose the key things to think about is making sure that you're back on track with regard to direct debits and payments and VAT returns that need to go in post the 30th of June. Have a think about cash flow. Is there anything that you are not doing as a business that can enhance your cash flow position from a VAT perspective? Could be simple things, like I said, from moving to different VAT staggers to making sure that you're reclaiming everything that you possibly can from a purchase perspective. Watch out for those property tricks. So make sure that you're comfortable that you're not going to have a VAT liability crystallise on things like TOGCs or any lease or any changes in property arrangements. And yeah, good news on making tax digital, and not so good news that Brexit is still coming. So that kind of concludes where I am. So we'll take questions at the end, and I'll pass you on to Katie, who will talk to you about R&D claims.
Thanks, Martine. Interesting, I haven't heard the Brexit word take centre stage for quite a while now. It's interesting we got to the end of your slide before we got reference to it. So hi, yeah, I'm here today to talk a bit about the potential for the hospitality business to claim R&D tax relief claims. And for those of you who haven't come across R&D tax reliefs before, these are effectively cash repayments or tax reductions that result from a business investing in innovation. And before I get started on some of the technical detail, I thought we'd take a pause. We're going to try, see if the technology works. And Jane, I think we're going to run a couple of poll questions. Are you ready for those? Jane? So can I ask everyone, are you currently making R&D tax relief claims? If I could just ask you to select one of these, it just helped me to tailor what I'm doing to know who it's relevant to. Oh. Okay. So good news that some of the room are, that's fantastic. So I'm going to spend a bit of time today talking about what the opportunity is. Jane, could we have the next question now, please? So this is, are you or will you be investing in new technology, whether that's as a direct result of COVID-19 or of your wider plans? So again, please just select one, whether it's yes or no. Okay, interesting. Okay, can we flick back to the other presentation? Thank you. And I think it's quite interesting, both of the results of those, and you'll see as we go through why I think those are important. And why I'm sitting here today really has effect because of two things that came to me. Firstly, we're seeing a lot of businesses change as a result of COVID-19. And I know Bernard talked a lot in the introduction, and there's an awful lot around those changes in business models and what's going to have to be done, both in the short term and in the long term, to cope with these changes. And secondly, because R&D tax relief is a cash relief, and I know that cash is a really key driver in this sector at the moment. So those two factors together just made us think that now is a good time to start to talk about R&D. So what do you need to know about R&D? Well, I've banged on about cash, so let's start with that. Cash refunds for R&D tax relief work out at 10% for large companies. So you're a large company if you have more than 500 employees in your group. There are other certain criteria, but that's probably the easiest benchmark. If you don't fit into that category, it's possibly you qualify for the SME regime for R&D tax credits, and those businesses can claim up to 1/3 of the expenditure in cash. So there's a real benefit in doing this. So projects, though, must involve some element of scientific or technological uncertainty and scientific or technological advancement. And I know that sounds quite difficult for this group and the sector, but we have made claims for various businesses in and around here. So I wanted to give you some examples to bring it to life a little bit. So firstly, we've helped an events company. They created an artificial intelligence system which they could use to personalize content. So effectively put the right events and experiences to their customers to help them convert bookings. And I'm very aware that that's a really important part of this sector in pushing from browsing to click-through and conversion to bookings. We've also helped Hotel Linen Company. They invented new systems, processes and technologies to maximise output and quality. And they needed R&D activity to identify that, test and implement the various changes. Additionally, across food and beverage, we see the development of new recipes and processes looking to increase shelf life of products, including foods. And Bernard talked into the introduction about the move to potentially pre-packaged foods. Again, this could be an area where we'd see some R&D. The creation of cashless payment platforms for restaurants. So again, this could be a way, as we move to more touchless systems, contactless systems, what do you need to put into place to create the right environment to cope with COVID-19, but also look into the future? And the adaptation of existing SAP systems, for example, to move to a passenger-centric model. So in the travel industry, for example, and aviation, those systems are very much focused around a passenger, which is very different to an existing SAP system. And those adaptations to relate to the sector can be really useful in terms of finding R&D. And hopefully those examples allow you to really consider and think about your business. And one of the reasons I asked that poll question in terms of investment in technology is you'll have seen a theme flow through many of those examples, not all, but many of them, where it's the application of technology in a particular setting that gives rise to R&D. And because I'm seeing greater investment in innovation or looking to technology to help through both the short-term and the longer-term implications of this, this could be a real area where we'll see R&D tax relief claims increase. So what's the size of the opportunity? Well, that really depends on what's done and how it's done. But each of the examples that I spoke to led to cash refunds, and many of those across multiple accounting periods. So something you set up in year one, you can use in multiple later years to both assess and start to report on the R&D claims. And if you've never made claims before, there's an opportunity to go back 2 years, because you have 2 years from the end of your accounting period to make a claim. So whilst we're also looking at future investment and current response to COVID-19, it would be useful to assess at the same time that which has gone before, to see whether we can include more cash. The good news for those 7% who said to me you're currently making R&D tax relief claims is that if you are making cash payments, HMRC are currently operating refunds within 28 days of submission of your corporation tax return. And I hear that's both for SME claims and large company claims at the moment. So for you, there's some good news in terms of how HMRC are operating in this COVID-19 environment. Next slide, please. So this slide, oh, you're slipping out that one. Okay, go back one. So some of the trends in hospitality that I talked to in terms of what's happening now and some of the claims that we've made for in the past. I think a trends in hospitality, when you look to the future, I couldn't find a great image to represent the hotel of the future, and I realised after I picked this one that there were no windows in this hotel, so I'm not quite sure how this building works. But it represents to me the future of the sector, and whether that's smart hotels, so advanced booking systems that I talked to you before, supporting the conversion of people into bookings, apps to connect you with your customers, or things like logistics and technology, whether that's regarding social distancing or just in future trends. So to create a, say, touch-free check-in system which could be implemented by way of mobile phones, for example, and the use of robotics in the sector. So what I'm really trying to do with this morning's presentation is just trying to get you that as you consider your investments, please keep in mind R&D tax relief, because they can make your money go further. So all of that thinking that 68% of you are giving to the investment in technology now or into the future, if I can tag on to that thinking the ability potentially to claim R&D tax relief on some of that and claim back between 10% and a third of those costs in cash reliefs, you can see how that would make that money go further. Okay, I'm ready, Mark, for next slide. So what do you do with this information? I just tried to whittle it down to 3 simple steps to take away and think about your business. So firstly, thinking really widely across the business about where there might be any amount of innovation. So that could be food, it could be technology, processes, new products that you're developing, or even the customer experience. When a customer walks into your hotel, what do they see, feel, hear? Some of those elements could contain an element of R&D tax, are qualifying for R&D tax reliefs. And that thinking really needs to be done within the business to help identify where we could go with this. Step 2 is simple. This is a finance update. What you're focused on is what's the bottom line. So estimate the cost associated with each of those items. And I've given you the 2 percentages that matter from an R&D tax credit perspective, that 10% and a third. So you're already doing a sort of mini feasibility in terms of what it could mean for your business. And the third step's important, because what you need then is to apply those R&D tax credit rules to that thinking you've given to the business. So I would really recommend that you talk to your advisor, pick up the phone to me, or just ask a question to knit those 2 together to see what benefit this could bring to your business. So that's it from me, short and sweet today. But if you do have any questions, please add them in and we'll address them at the end.
There was one for Robert from Jim, who mentions that after the 2008 crisis, EBITDA multiples fell significantly. What do you think this does for deals in progress and also possible opportunistic purchases going forward?
Thank you very much for the question. Well, that's a very good one. I mean, I think, and I'm sure Ryan would have touched on this or will touch on this. As far as I can see, that the industry is going to be in a very fragile position, and I'm afraid that there are people out there, and some have described them as vultures waiting to swoop, because there's plenty of funds, private equity, whatever, who've got sitting on piles of cash, and people will always look for the opportunity for distressed purchases. So I can't possibly comment on EBITDA multiples because they will all plummet during the course of 2020. Having said that, because the industry is recognized as being able to bounce back, and I think that a lot of people will look at 2019 as the then normal, and 2020 or 2021 is the new normal. But from the forecast that I mentioned, yes, there is nervousness, but there is, I think, I'm always a glass half full person, and I think that by 2022, 23 at the latest, we will see a new normal. But by that time, I would expect there to have been a considerable number of transactions.
Great, thank you for that, Robert.
Hi there, I think I've got, hopefully you can hear me now, it's Ryan.
We can indeed, Ryan, go ahead.
I have no idea what happened there, but please bear with me. I'll keep it short and sweet because clearly we are over time. But I just sort of wanted to sort of give a view about what we're seeing in the restructuring market at the moment, particularly in the hospitality side of the business, to which I've spent probably the last 20 years helping particularly retail, restaurants and bars and hospitality businesses navigate out of stressed or distressed situations. I purposely haven't got any slides today because we're finding the market and the position is almost changing on a daily basis. It's quite a fluid market. So what I'll try and do is I'll frame what we've been seeing with that rethink model that Mark talked to earlier, which is the colourful hill landscape, that slide that he presented. And particularly this between the react and the resilient side. So this safeguarding the business stage that we saw at the beginning, and then the trying to keep your business running in the resilient side. And I think what I see is that we haven't completely come out of the react stage. We keep bouncing between react and resilience because of all the changes that keep getting keeps getting put through, whether it be by governments or various announcements that are happening. So in the first phase, I guess what we saw is we saw a lot of running around and a lot of action of what businesses could do. And then the government came in with all of their sort of levers that it presented to the market and to the whole of UK business. The job retention scheme, C-bills, CL bills, bounce back loans, rates holidays, crown deferments, restriction on landlord enforcement, which was a massive one, and that's at least until the end of June, lender and financing providers forbearance for payments. So with the exceptions of the C-bills loans from the banks, these levers were presented to every single company, whether they were poor performing or were a successfully performing business. So this sort of masks the impact of what was happening with business performance. So whilst the government assistance, we saw it very timely, and yes, they should be applauded for what they've done and has built and continued to build. It is creating a lot of liabilities within the UK balance sheet, and the skill will be within the restructuring as we come out of this is how this is all released. So the government are sort of needing to introduce measures to assist in this release. We've talked about the time to pay arrangements that were covered by my colleagues, but what we're seeing is that this is all deferment. This isn't sort of debt forgiveness. This has to unwind at some point. So we're beginning to get to that point where people are considering that. And I guess the sentiment at this early stage was covered when Travelodge announced their intention to go into CVA, but in late April, it was interesting that the court granted Travelodge an interim injunction to prevent winding up applications that was submitted by various landlords. And it was basically on the intention that legislation was coming out that was going to suspend winding up petitions, and that a plan for restructuring, which hadn't been presented yet, would produce a better result for the creditors. So that's quite unusual to allow that to happen. So it shows the sentiment that actually everybody understands that we need to find a time to work through this, because this isn't a recession or anything we've seen before since the Second World War. This is something that's affecting supply and demand, and it's very different to the financial crisis in 08-09 because there's still liquidity in the market. So sort of where we come from a restructuring perspective, this all requires very slow and careful thinking to navigate this. So the government intervention has bought businesses time to do this. So as we come out of this react phase, we're sort of going into this resilient phase, and what have we seen, particularly in the retail, leisure and hospitality sectors? We are seeing that anything that a business needs to come out of this period, they need to be viable and they need to be able to demonstrate that. But this all comes with the view that we all know what coming out of lockdown looks like, which businesses don't. So how do you forecast what your occupancy rates are going to be? How many covers are you going to do in the restaurants? It's very hard to predict, and for that reason, it's very hard for businesses to go and secure refinancing or complete any restructurings, because all of this requires an individual, such as a restructuring professional, to say, yes, that's all reasonable and it's valid. And at the moment, many of us don't know how long this will take to get back to whatever the new normal is. So within retail, leisure and hospitality, we've definitely seen sort of, there's a lot more conversations happening about CVAs, but there's a misconception a little bit here, because this is a drive really to try and get landlords towards a more turnover rent position, but there's a bit of a perception that this is just something quite a crude, blunt method to introduce and sort of cram down the landlords. It's quite an involved piece of work, and there is a lot of court cases around how you have to treat all the creditors, but particularly landlords, fairly. So I think what we're seeing is everybody sitting and waiting. There's a few, like we mentioned, the Travelodge CVA that's been launched. But a lot of people are saying, okay, what does this mean? What are landlords giving? Because all they're giving at the moment is, again, deferments. Nobody has come out and sort of moved to turnover rents, which is probably what this business needs, or what the sector and the whole economy needs to come out of this stage. It was interesting with the C bills and CL bills that came out, because these have been difficult to obtain for a number of sectors, particularly retail and R&B, because these were underperforming prior to COVID. So in terms of, it is a backward-looking test about viability and a forward-looking test. So we've seen that there's been quite a few restrictions on these methods being provided out. However, in saying that, what have we seen from the banks? We have seen, a willingness to work with their customers. They're very supportive. I think we receive a lot of our introductions from lenders, and I have to say that we haven't been introduced to many situations in the last probably 10 weeks. It's mainly direct from corporates and PE, so it shows that they are trying to do the things that they are trying to do. They will provide covenant waivers, they will provide capital repayment holidays. And I think the main thing for them to realize, that they're realizing, is that there's no easy solution here. The enforcement's just not an option for them, because it just crystallizes a big loss. But all of the options that the business face, they all need some form of support to get there. I think overall, the way that I've been approaching this in situations is that there has to be an appreciation that we're all in this together. It's come out in various themes today that this isn't about turning to one stakeholder in the business and accepting and expecting them to provide a silver bullet and a solution for this. This is very much, what can everybody do? So, what levers can be pulled? What can all stakeholders, debt providers, equity providers provide? I think that's where we found most of our restructuring conversations happening, is by negotiating and sort of speaking to these stakeholders without needing to initially go through any blunt sort of restructuring implementations. So we need to help businesses get the forbearance they need to navigate their way out of this. There are a number of corporate governance and insolvency reforms that are being put into place to help this, and there's this concept of moratorium, which effectively allows a business a period of time to navigate out of its difficulties, but it has to be able to maintain its ongoing payments. So it is proving difficult, but it would appear that everybody's watching the restructurings as they unfold. Who goes first? There's lots of conversations about how they go about speaking to their stakeholders, and what we're seeing is that there is a more sort of negotiation approach to, say, landlords and stakeholders to try and work with them without going down an expensive route of restructuring. And the other thing to be mindful of is that the government have announced that they're going to bring back Crown Preference in December 2020. That's been delayed. It would be surprising if they do bring this in, because that really does sort of move them in a priority state where businesses need support, and it will affect the way that funders look at it. So that's something to be aware of and be mindful of as we go down this time. So in terms of what we say businesses need to do in this situation, it's all very much about being proactive and reactive to each change and measure introduced. there's announcements, as I say, on a more or less daily basis, and everybody needs to ensure that their forecasts and their short-term forecast sort of monitors and reflects the daily changes, i.e. the furlough updates, how that filters through, and also assess the creditor build-up, because we say this is all being parked at the moment, and how does this get released? And that just needs to be balanced with the mantra of everybody's conserving cash. Use every available measure, draw down all available facilities, cancel direct debits, be in control of your business's cash. The time to pay points are important, because what we're finding is that people are asking what time to pay agreements will HMRC accept. I think what's important is you should model it through your cash flow to find out what the business needs, because there's no point asking for something that doesn't work for the business. Convert fixed cost to variable has been key. That's particularly with sort of landlords, leaseholds, trying to get it to be based on turnover like rent. But it's got to be a fairness in all of this. What we've noted is that landlords have felt quite beaten up through this process. They've had restrictions placed on them. That means they're not being paid, they can't take any action, and it's likely that will need to be extended past the end of June, because you can see the government can't do all what they've done and have the position affected by enforcement actions being able to be taken. So I think the message that we have is that speak with your lenders, speak with landlords, speak with the supply chain, and provide information to them, because when we come to negotiate with them and they haven't been communicated with, the relationship is quite sour and it's quite difficult. But we find where businesses have been open about what they can and can't do, that is really important. So it's all about that balanced balanced scorecard that you need to present. So I think in summary, I just say, stakeholder management is key. We're all in this together, and we need all stakeholders to provide balanced support. And the government will keep applying new measures as we go through this, because they simply can't let all of the investment that they've put into the UK economy go to waste. So we need to get to a point where we can control and release out of the situation, and navigate out of this, as I say. So that's it from me. That's what we're seeing at the moment in the restructuring world.
Brilliant, thank you very much there, Ryan. So we have actually gone over on time. It's 10:15, we were due to finish at 10, and I see some people have had to drop off, obviously, to go to other meetings. But I think perhaps if we just do take a few questions, and then some of the questions we can go back and we'll put a question and answer on the website when we post the webinar up within 24 hours. There seems to be quite a few, David and Sabir, asking about the job retention scheme and council grants, and just wanting to verify that they're not liable for VAT because of the no underlying supply, and furlough funds being exempt income, and then impacting on the VAT recovery. So would that be one for Martine or John to answer?
It's probably one for me, Jane. Normally grant income is not considered to be a taxable supply at all, so it's considered to be something that would be treated as a non-business outside the scope type of revenue. Interesting concept around VAT recovery, because if you are operating a business and you have non-business revenue, then you might have to do a business non-business calculation in order to look at your VAT recovery position. I've not seen anybody question that with regard to COVID. So I think it's going to be something that I will take away, and I will ask HMRC and come back to the team in that respect. I would have thought it would not be considered to have any restriction in respect of business activities and VAT recovery, on the basis that it's something that's quite unusual, and otherwise all businesses would have to consider their position, which is probably contra to the VAT rules in their entirety. So leave that one with me, and I will come back on the Q&A and confirm that piece. But my anticipation is that HMRC will not look for a restriction.
Great, thanks. And picking up on one thing you said there, Martine, we've got quite a long query on somebody who made an agreement with HMRC but has since got one of those probably system generated letters that you mentioned. But what they are trying to do specifically is contact HMRC and are just getting nowhere at all. So have you been able to contact HMRC, and is that by telephone if you have?
Yes, so Jane, I think this is the question you sent me this morning via email, so we'll come back separately on that point. But as a general point on the call, if you've agreed a time to pay arrangement prior to COVID happening, the question there is, can you rely on the VAT deferment arrangement that HMRC have put in place in order to not to have to pay those time to pay amounts? And I think my advice would be that you would need to speak to HMRC directly on that, because when HMRC look at what VAT can be deferred, they merely talk about payments due on VAT returns. And if you have a separate time to pay arrangement, they would typically still expect you to make those payments. Have I been able to contact HMRC? Yes. There is a COVID helpline. We can provide details for that. So I'd either go through the COVID helpline if you don't get any luck with regard to a telephone number on the letter, or the general HMRC VAT helpline is still running. It's taking probably about half an hour to 45 minutes to get through to them, but they are answering. Some departments have closed down, some departments have turned their telephones off, but you can still contact them through the general helpline and the COVID helpline. But anything non-standard, I think you definitely have to speak to HMRC about.
Brilliant, thank you. A question for John. Can you just confirm that NIC and PAYE in relation to furlough payments must be paid when they fall due and there's no ability to defer these? John, we can't hear you. Let's just unmute you let me see if I send you an unmute. There, John, did you hear that question and are you able to answer it?
Yes, I did, and yes, I can hear now. So yeah, to confirm that the PAYE and NIC in relation to furlough is not going to be permitted to be included in the time to pay.
Okay, great. And one, I think here for Katie, would the R&D qualify for CapEx or for OpEx as well?
Okay, that's a great question. R&D is, it can be claimed on intangible assets. There is a separate scheme for CapEx, which is R&D capital allowances, which effectively give you a 100% deduction in year one. But if you have capitalised, we talked a lot about technology, so if you've got items capitalised as intangible fixed assets, you're not prevented from claiming those R&D cash benefits, and they can be even more worthwhile in terms of the tax deductions that you can get for them. So definitely include CapEx in your thinking.
Brilliant, thank you. And there was mention of reinstating direct debits for VAT so that you don't unintentionally miss a payment. But the question from Nigel is, will the deferred amount be taken straight away?
No. So I think you have to make an arrangement, well, you have to make payment to HMRC by March, but it won't come out as an automated direct debit. So your direct debits will be per your normal VAT returns that will be due post 30th of June. So they do expect you to make the payment for the amounts due that have been deferred, but they wouldn't be looking to take the full amount. So no, I wouldn't expect the direct debit to automatically take your deferred VAT out at any stage.
Great, thank you. Got a question here about buying out the bank debt on your property. How do you negotiate and negate the anti-embarrassment clauses and the clawback clauses on future gains that the bank like to include? I don't know who wants to pick that one up. One of you, I'm sure, will.
It's Ryan here. I'll pick that up in terms of what I see when people are trying to buy bank debt. The anti-embarrassment is there as quite a standard position, because the bank has often got to justify why it takes that position, and they've been criticised in the past. But often what they will do, particularly if they're looking at it at a discount from what they were holding it as a valuation, it's unfortunately one of those things that you can't necessarily get out of from the bank's perspective, because it's very much a credit-driven policy. So I'd say that I have not seen many people, if any, to navigate that and get that out of contractual documentation.
That's brilliant. Thank you very much for that, Ryan. I think, looking at the rest of the questions, they all seem quite specific, so we might address those after this. So now might be the time to draw this to a close. But just to say that if you have got an unanswered question, please do refer to the website or send that across to me, and I can direct it to the correct person within BDO. But thank you all very much for joining us today. Always a wealth of information presented clearly by the team at BDO, so we are very grateful for that. Thank you very much. As I say, the webinar will be shared on the website within about 24 hours. Next week, we will return to our regular slot at 10 o'clock on a Wednesday morning, and we will be discussing the pros and cons of opening and when is a good time or the appropriate time to open. I will be joined by Michael Grove from Hotstats, Michael Hayward, one of our board members, who will be speaking with his vast revenue management experience, and also David Bridge, who will represent asset management and the views of the owner. So that's next Wednesday on the 17th of June. And the following Wednesday on the 24th of June, we are doing another webinar on reopening in conjunction with Amadeus. And this is much more of an operational guide when you have your reopening date and schedule in place. On that webinar, we will also be joined by Peter Ducker from the Institute of Hospitality. So I would just like to say a very big thank you to everybody that has listened in, and especially to the team at BDO. So thanks very much, Robert, Mark, John, Katie, Martine, and Ryan. Thank you so much. And any questions, please send them over.